I'd like to start by talking about the very long bull run that we've had in stocks at this point. The bull market's almost 9 years old. Some Cassandras, myself included, have been worried that markets have been overvalued and that stock prices have been too high, especially in the United States over the last couple of years. Is a slowdown or even a market correction looking more likely in 2018? Savita, I wanted to start with your take on that.
Sure, yeah, it does feel sort of unsettling that I think by next July, we will be in the officially, if the market continues to go up, we'll be in the officially the longest bull market, by technical definitions in history.
Yes.
And that doesn't feel too great. It doesn't feel good to buy equities now. But I guess, if you think about 1999, it was a year where valuations were getting high. One sector was driving most of the returns of the S&P 500. It didn't feel great to buy equities. Yet that was one of the best years of that bull market. So I guess the risk to me is that if it's not over, you don't want to miss it at this point. And when I look at trends in earnings, when I look at valuations, when I look at kind of sentiment measures for the S&P 500, it's not like we've hit these levels of euphoria where investors are all in, there's no other game in town, and stocks look like they're going to go up forever. You're not hearing that rhetoric, really. You're really hearing more about what could go wrong rather than what could go right. So I would argue that sentiment is shifting from skepticism to optimism. At some point, it'll peak out at euphoria, but we might not be there yet. And then on valuations, the market looks a lot more expensive on a variety of valuation metrics, but it turns out that valuations are a really lousy market timing model if you're concerned about what happens over the next 12 months. The amount of returns that are explained by the PE ratio are basically close to zero. And that's what makes me think, yeah, it doesn't feel good to buy. Stocks look expensive, but the last year or two of a bull market are actually where you get the strongest returns.
You invoked 1999 earlier. One of the better performing areas of the market in the past year has been technology.
Yeah.
But Dan, you were saying to me earlier today that by a lot of measures, actually the valuations of tech stocks relative to history is not that high. Can you explain a little bit what you mean by that?
That's correct. So if you look at the 20-year median PEs of each sector, even with the run that they've had right now, actually technology and also healthcare are basically trading at their median PEs. The sectors that are trading actually at premiums are actually materials, utilities, staples, and industrials, where they're at somewhere between 14% to even close to 20% premiums to those mediums. So by that measure, technology and healthcare actually remain reasonably valued.
And Byron, you had been mentioning to me that within the tech world, there's tech as a sector has essentially become so large that you are really talking about an umbrella that covers many different parts of the economy. And you were saying that in some of those areas, the opportunities still look both reasonably priced and really kind of poised for a lot of growth. Can you tell me a little bit more about that?
Yes, absolutely. So as good as the bull run has been around tech, where it's outperformed the other indices roughly 2x, we passed some major milestones last year that I think show it's due to fundamental business performance. One of those milestones that was a great event, July of this year, the 5 largest market cap companies on the planet were all venture-backed tech companies. Going down the list with Apple, Alphabet, Microsoft, Amazon, and Facebook. Number 6, by the way, is Alibaba, also venture-backed, but yes. Chinese. And so they have passed the Berkshires and the JP Morgans and the Exxons for the world's most valuable companies because of fundamental business performance. And as you think about the trends ahead, mobility, machine learning, cloud computing, a lot of these tailwind trends that are ripping through large portions of the economy are increasing and going to continue.